Welcome to the Dealmaking with Laura DiFrancesco podcast. I'm Laura DiFrancesco, your host. We're talking all about mergers and acquisitions, buying and selling small businesses, as well as corporate law. We are taking our experience closing over $10 billion of transactions since founding Dean Street Law 5 years ago, and my experience being an M&A and corporate attorney for over a decade and making it accessible to you as an entrepreneur. I hope that this helps you in navigating the complex world of mergers and acquisitions. And also, we're always happy to be a resource for you here at Dean Street Law. You can always apply to work with us through our complimentary consultations linked in our show notes. And a huge shout out and thank you to everyone who's subscribed and left us a 5-star review. If you haven't yet, be sure to subscribe and also leave us a 5-star review. It's one of the best ways to support us as a small business. And also be sure to share with your friends and colleagues on social media, through text, email, or however is easiest. It means the world to us that you're supporting our content and helps us make more to support you in your journey. Welcome to the Dealmaking with Laura DiFrancesco podcast. I'm your host, Laura DiFrancesco, founder of Dean Street Law, your boutique M&A law firm representing buyers and sellers, buying and selling middle market, lower middle market businesses. I'm really excited to share my new book, Entrepreneurship Through Acquisition, a legal guide to buying a small business. It is something I'm really excited to share because access to legal knowledge has been one of the biggest reasons that I became a lawyer to begin with. I became a lawyer to be an entrepreneur because law is the fabric of business. It's the rules by which we play the game. So in order to be successful in business, you have to know how to play the game. And that's why I've wanted to make the legal aspects of what we do so much more accessible. M&A, mergers and acquisitions, buying and selling businesses is the creme de la creme of corporate law. It is the different facets of corporate law all coming together in a beautiful, creative way of buying and selling a business. You're going to see corporate law, contracts, finance, real estate, intellectual property, and so much more when you are delving into buying or selling a business. Now, as an entrepreneur, you may be thinking, okay, great, but I'm going to have my lawyer take care of all of that. Totally fine. And we respect that. We'd love to work with you at Dean Street Law. With that said, we always want to be able to empower entrepreneurs to understand the legal concepts so that they can make well-informed decisions and ultimately decide how they'd like to take on risk, mitigate risk, and be able to drive the ship. We can advise, but ultimately the entrepreneur, the buyer, the seller, they're the decision maker. And we want to empower them to be able to make good decisions. Ultimately, that's going to influence profitability, money on the table, everything. So I really wanted to share how you can buy a business and how you can do that in the best, most effective way possible. What's the different strategy that you can use, how you can understand what fundraising can do for you and what it will require from you, different legal structures for buying a business, what's appropriate when, and what you can expect as you go down the road. So today we're going to be talking about the timeline for buying a business. And if you want this, but in more depth, the book is going to be a phenomenal resource. You can access the first chapter for free so that you can see what you're getting your hands on. And then also pre-order, leave us a 5-star review, anything above would really support us. So with that said, I'm really excited to get into the episode of the timeline of buying a business. So you may be thinking, I want to buy a business, now what? How long is it going to take? When can I expect to do this? Obviously, when you're buying a business, it's like buying a home on steroids. If you're thinking about spending $400,000, $500,000, $600,000 on a home, you may be thinking of spending $2 million, $5 million, $20 million on buying a business. So it can really require quite a significant amount of financial planning, life planning, and ultimately business tactics, strategies, and overall business planning. So we can't necessarily say how long it will take you to buy a business. It's all going to depend on your requirements for buying a business. Are you geographically constrained? Are you constrained by industry? Are you looking for the diamond with no flaws, which doesn't exist? Or are you going to set realistic expectations? How much time are you going to put into this? That will all drive, as well as your approach for finding a business, negotiating, legal counsel that you involve, the business that you decide to buy. All of that will impact the overall length of time that it takes to buy a business. But most find that if they'd like to buy a business, they can generally buy a business within 2 years if they have the right mindset, the approach, the funds for it, and the constraints within it, and their buy box are sufficiently broad to be able to buy a business. A lot of people think, oh, well, there's so many people getting into entrepreneurship through acquisition. It's so competitive. There are so many businesses for sale, and there are even more businesses that don't sell and that dissolve or go out of business because they don't even know that they have the option to sell the business, or they don't know how to sell the business. So there are so many businesses out there. There's more than enough for everyone. If you're looking for a business and you have the right mindset and the right buy box, you can certainly buy one. So let's talk about the general phases of buying a business. Now that we've talked about the overall timeline, you could do it in 4 months. You could do it in 2.5, 6 years. Just depends. Just like buying a house, you could do that in a couple months, maybe in a couple days if you're paying cash, right? Or you could do it within a couple years. So it's all dependent on you. Within that, though, there are certain timelines to expect. So once you get under LOI, if you've already engaged with a lender, expect it to take 60 to 90 days. Few lenders, almost no SBA lenders, can close in less than 60 days. With that said, if you're buying cash, you may have more flexibility on the timeline, but know that there will always be a component of the timeline that's out of your control. Seller's counsel, opposing counsel, response times for the other party, if something happens in their life, if someone goes on vacation. We've had situations where sellers are on vacation for 6 weeks, and then the transaction was trying to be designed around that time period so that we could get as much done before and after that time period of being out of office. So there's many different things that influence it. I will say if it's a licensed business, expect it to take longer. If you are fundraising and do not have the funds in hand, expect it to take more like 120 days. When you're thinking of the timeline, I would say give yourself 90 days after the LOI has been signed. If you're not fundraising and if it's not a licensed business, give yourself 120 days if it is a licensed business or it's something where you're fundraising. And you want to be going on multiple tracks at once. Now, there's a few things that can condense your timeline. If you start legal right away, it will condense your timeline. But of course, if you wait until after you receive the Q of E report, which may be 6 weeks after your LOI was signed, then you're going to have legal take longer because you need to do due diligence and preparing the documents, having them sent out for review, getting comments back. Expect 4 to 6 rounds of negotiations on most of the material transaction documents. The purchase agreement, certainly 4 to 6 rounds of negotiations. The seller notes or the loan documents might have 3 to 6 rounds of negotiation. Employment agreement might have 4 or 5 rounds of negotiation. So a lot of folks think that all of a sudden they can sign the LOI and then they can engage legal and the deal will be done in 2 weeks. And that's simply just not true, both from a fact of you would be doing yourself a disservice if you moved through it that quickly. I did have a $50 million deal that we worked on when I was in Big Law, and we closed it in less than 2 weeks. And guess what? They found that the business had to immediately be put in default on every one of its loans. It was immediately working through the debt service coverage ratios and being in defaults and having to pay fines and fees because they didn't spend the time diligencing cash flow and the quality of earnings to actually assume a business that was doing well financially. Immediately, it was going through default processes and progressing towards bankruptcy. That's not something that I want you to be doing, especially if you're spending $50 million. So spend the time necessary for each phase. It will pay dividends in the long run. You want to buy a business you think you're buying. You want to spend money investing it proactively to garner a higher return on investment. The easiest way to sink funds is to buy a business overpriced that you shouldn't have bought. So we want to do it right for the first time. It's going to cost a lot less than doing it wrong. And part of that is building in sufficient time for every component of the transaction, both from quality of earnings and financial review, even if it's not quality of earnings, to legal, to response times, documentation, getting it all right and getting it wrapped up well. When it comes to navigating corporate law, entrepreneurship, and managing small businesses, experience matters. Dean Street Law is a boutique corporate firm specializing in mergers and acquisitions and additional focus in real estate, commercial transactions, finance, and corporate governance. With over $10 billion in deals closed, Dean Street Law has extensive experience representing hundreds of clients in thousands of transactions, from small businesses to Fortune 500 companies. Whether you need startup guidance or advice on closing multi-million or multi-billion dollar deals, we're your trusted partner every step of the way. Visit deanstreetlaw.com in the show notes to schedule a complimentary consultation. So the different phases are going to include your search phase, where you're looking for businesses. This can really influence your timeline and your strategy for searching. What is your strategy? Are you going solely on off-market deals that you're sourcing proprietary search, or are you only looking at the websites and trying to find a deal? I find that most of our clients that are successful are doing a blend. They're looking at what's online. They're a part of those membership communities such as Rejig and other platforms for buying a business, and they're also doing their own proprietary search. So if you have multiple sticks in the fire, then you're more likely to have something more successful and more fruitful for your acquisition and finding the right business. You have to get a deal under LOI in order to be able to buy it. Well, generally you'll have an LOI before you buy a business. So in that search phase, you're evaluating businesses, and you want to be able to get to a litmus point where you know whether you want to proceed forward with negotiating an LOI quickly. And that's with having a sufficiently defined buy box. Sometimes if you don't have a sufficiently defined buy box, you're looking at too much and you're spending too much time early on looking at so many different opportunities instead of going deep and working through actual one-on-one conversations about valuation and working through developing that relationship. Now, I always say to folks, if you find that you like a business and it's not getting to LOI, always have a follow-up strategy, because time is your best friend in many different respects for buying a business. And the more time that you have, the more you're able to leverage that for your benefit on better terms or better timing or better financials. So time is your friend when you have time on your side. And the best thing to do is being able to have as much time as you need to find the right business, to negotiate the right deal, and to get to closing. So then once you have selected a potential target acquisition, then you're going to be getting into negotiating your initial documents. So first is going to come the non-disclosure agreement. That is generally signed before the seller provides 3 years financial statements and tax returns, so that you can first take a look at what is the general valuation of this business subject to confirmation, that I can put forward in an indication of interest, which is a very preliminary step that most people skip. That might just be if the seller needs confidence to provide additional information about the business, or even to provide financial statements, they may require an indication of interest, which is written documentation that you are indicating your interest in proceeding forward with a transaction. Most people immediately after an NDA is signed certain financial confidential information is disclosed and a buyer is able to do calculations on purchase price, they will skip the indication of interest and immediately go into the letter of intent. The letter of intent is the foundation of the transaction. And you have to think about this strategically. If you are in a really competitive situation, you may not be able to get through as much fundamental terms of the deal within the letter of intent as if you were in a proprietary search and you're the only person working through this LOI with the seller. So in a competitive situation, you're really going to have to balance the need for setting the tone and foundation of the transaction so that as you're investing in quality of earnings and legal and everything else, the buyer tends to invest considerably more quickly than the seller in a transaction because of the need for due diligence. So you want the foundation of your deal to be good enough that it is worthwhile to invest in those. But you have to balance that with how competitive the market is if you're in a competitive situation, and you might not have everything fine-tuned and nailed down in the LOI if you have a competitive situation. If you have a non-competitive situation, you still may strategically have things that you decide are going to be post-LOI conversations, but you want to make the foundation in your LOI as good as possible because that will be the foundation for all of the transaction documents going forward. Your LOI will set forth not only the general terms of the deal, which are technically non-binding, but you are going to be investing a lot of money on the expectation that those are true. And one of the questions that I've seen on social media quite a bit is about the valuation of the business in the LOI. That should be your good faith valuation. The absent misinformation being provided, that is what you're buying the business for. Obviously, the quality of earnings is going to show you the financial health of the business, but the expectation should not be that you're putting something in the LOI and then you're going to reduce it down through negotiations throughout the deal in bad faith. You should be acting in good faith, both because it's legally required and you can be sued if you don't, and also because it's your reputation on the line as a buyer. There's companies that literally say we close on the terms of our LOI or we don't close at all in order to give sellers comfort that they're not going to be backtracking the numbers after they get into due diligence for minor things that are expected. You know, there's going to be hair on every deal. No deal is perfect. No business is perfect. There's going to be some complicating factors, something that comes up in due diligence. It's not a if, it's a what is going to happen and how are we going to deal with it. So when you're putting forth an LOI, you want to be able to stand behind that number. You should be doing sufficient due diligence on it and being able to put forth the terms. Now, sometimes that requires that you have had conversations with a lender and you understand their lending requirements and their underwriting requirements. For instance, if you're doing an SBA loan, there are a lot of requirements for the SBA. So you should absolutely have an attorney look over your LOI. Some folks try to do it yourself. We do have support for that. We do have our template LOIs in Acquisition Insights, our course on the legal process of buying a business, if you'd like to do that. And then other folks just want an attorney to handle it because it is something that's a legal obligation. And even though the terms of the LOI of the transaction, whether it be the non-compete or the purchase price, are going to be non-binding, the vast majority of the LOI actually is binding. The confidentiality, exclusivity, termination, all of those components, due diligence, what you have the access and right to as the buyer, all of those are binding components of most letters of intent. It's obviously going to depend on what you say are non-binding versus binding in the provisions of the LOI. Once you have the LOI signed, and most people are either keeping their lawyer in the loop as an LOI is approaching being executed if they're doing it themselves, or they're engaging their attorney right before the LOI is executed, because as soon as the LOI is executed, even if you didn't have an attorney assist with the LOI, you absolutely need to have an attorney involved immediately after the LOI has been executed, because that's your ticking time of the exclusivity period begins winding down. You want to be using your time judiciously and making sure that you're making the most of it. And as soon as we're engaged as counsel at Dean Street Law, we put together a closing checklist and timeline. So it's going to show you in a Gantt chart how, if this is our target date, what we need to start by which time in order for you to close on time. Folks think that they can just start documentation, purchase agreement, ancillary transaction documents 80% into your closing timeline from LOI to closing. And that's simply not true, because that component that we can't control of, first off, it takes time to draft hundreds of pages of transaction documents. Purchase agreements for any $1 million deal is going to generally start at 25 plus pages. By the time that you get to all of your 12 to 15 transaction documents, you're talking about at least a couple hundred pages of transaction documents. It's even on the smallest deal, this amount is required both for underwriting. Your SBA lender, your lender will not approve a deal that does not have the legal mechanisms for transfer, consents, secretary certificate. If there's a stock purchase or a purchase of the membership interest, making sure there's resignations and then officers' appointments, right? All the things that you may not be thinking about as the buyer, but your attorney is going to be thinking about, attorneys should be thinking about, and your lender is going to require, or your investors are going to require to fund the deal. We have to make sure that all that documentation is started soon enough. Generally, you would say that you want due diligence to be completed in the first third of your closing timeline, and you would like your documentation to begin at that first third. But I will say it's also about managing momentum and making sure that you are keeping the seller engaged and comfortable. When you get into due diligence, particularly if a buyer is taking too long, they are creating frustration with the seller because the seller is not seeing anything. They're just getting asked a barrage of questions that are generally more intrusive than any transaction that they've ever done, of transaction documents and questions about how things are operated and someone looking over every single thing that they've done. It's a very intrusive process for a seller. So they're going to be looking for the transaction documents as soon as possible because they want to see that you're actually doing something. They're not seeing that you're doing something as a buyer until you're delivering documentation to them. So generally, sellers are going to want documentation as soon as possible to see that you're actually in this and you're not just wasting their time, especially if they've had a bad experience. And honestly, with the rise of ETA, as great as it is, there is a rise in the number of people who are on the buy side and maybe spending and wasting someone's time on the sell side without meaningfully progressing the deal forward. So both from actually we need to get to closing, and in order for us to get to closing, we need to get these things done in these timelines. There's that perspective. And then there's also the perspective of, if you're not moving the deal forward, your likelihood of closing is diminishing day by day. Momentum can either be your friend or your foe, depending on how you're moving forward in the deal. Meaningfully progressing it, giving something to the seller to show and evidence the meaningful progress, and then also accounting for the time that you can't control, whether it be consents that you need to obtain or even feedback from the seller on the transaction documents or government approval, right? All of those things become things that are out of your control. You have to build the time into the timeline to allow for those. That's why I say you're going to need 90 days to buy a business if you're doing an SBA deal, because between due diligence and everything else, plan for 90 days, hope for 60, plan for 90. Always hope for the best and plan for the worst, because ultimately that can have a very significant financial impact both to the seller and to the buyer. The business may be in requirement of equity injection. The seller may have debts that it needs to pay, or even as simple as the cost of financing may be increasing. If you'll believe this, when I bought my farm, it took me over a year to get government consents that shouldn't have even been required for purchasing my farm for a long reason we won't get into. Anyways, the interest rate on my loan jumped from 2%. like 1.8% that was quoted when I first was buying the business to 6.75% at closing. And you can imagine how painful that is to be buying the same thing and be paying almost triple, definitely more than double for it, just because the cost of interest rates increased so significantly during that time period. Time is money, and being honest and transparent about the time that it takes, but moving forward as quickly as you can is the best way to mitigate the risk that that time will cost you so much money. And then after due diligence and documentation, of course, there's preparation for closing itself. Plan for preparation for closing to take a couple of days. A lot of people think that as soon as you agree to the transaction documents that you can sign the next hour. It takes a half a day to a full day just to prepare all of the documents for execution. That may seem so simple to you, but we have a list of the 15 plus transaction documents that need to be signed in connection with closing. We have to make sure every single exhibit is updated, every single date is completed. And guess what? If you switch closing date, then we've got to do that process more than once. We've got to do that twice or three times. It takes a minimum of 5 to 6 hours just to date everything, compile all of the PDFs, upload them all to DocuSign, put in all the signatures, triple check it. And this is not something that you want to rush, because imagine signing the documents with the wrong numbers or the wrong dates or the wrong attachments, right? This is your legal obligation. It can't be done wrong. We triple check this, and it's important to have that time built in. So you know, okay, one, in order for legal to prepare the documents, it's going to take that much time. But also, did you know that if you're getting a loan, you have to have all of the documents actually ready for signature, not just approved and via email, but they need to be compiled, and a closing date needs to be set in order to pull payoff letters, in order to get the lender to sign off on it. And we've had a lot more instances where we've seen where the lenders have a closing team and it's not internal. And so approval for closing may take 3 to 5 business days. So you have to not only have every document ready for signature, but then you also have to get payoff letters and working capital numbers and everything like that, those closing mechanics. And you have to get underwriting approval from the lenders that everything's good to sign. And you may need 5 business days for that. So a lot of people don't think about those minute details. That's why we have a closing checklist and timeline. That's why we send it out at the beginning of our engagement so that everybody's on the same page of what's expected and what we need to complete in order to get to closing. And this is where communication and clarity is not only kindness, but it is also your path to success. Because when you share with the seller who is not as engaged with the process of selling a business as you may be engaged with the process of buying a business, they may not have gone and to conferences about selling their business. They may not have sat in webinars and listened to podcasts about the process. They may not have as much information about the amount of documentation and time it takes to sell a business. And so when you're able to communicate that, that enables the emotional regulation of the process to go a lot more smoothly than if all of a sudden, out of nowhere, you send them 15 transaction documents and they're not expecting it because they haven't documented any contract in their business, except for maybe their contract with their cell carrier since the beginning of time, right? So communication and clarity is not only kindness, but also it is a key to success. And that's really important to remember. That's why we work so proactively at Dean Street Law to support our clients, because that minimizes the likelihood of the deal falling apart. Everything that we do, the way that we structure our services, to how proactive we are, to the different information that we give our clients, the advice that we provide, is all with the goal to best support them to make the decisions that are best for them, and also to not deteriorate the likelihood of going to closing, because these things all impact that. Thinking about buying a business? Unlock the secrets of successful acquisitions with Acquisition Insights, your legal roadmap for success. With over 81 modules of video lectures, written materials, guides, and checklists, We provide in-depth guidance to navigate every step of the process. From initial interest to closing the deal, get the expertise you need to make informed decisions. You can also access our battle-tested templates in the Acquisition Insights course and templates bundle, including our template LOIs, letters of intent, pre- and post-LOI due diligence request list, material deal terms lists, and more. Visit lauradifrancesco.co/the-shop today and take the first step towards buying your dream business. All the links are in the show notes. The common delays that we see. So what slows down and what speeds up a deal? Number one thing is lack of meaningful progress, like I mentioned. The number two thing is financing. It will almost always be financing or funding or valuation issues, either with the Q of E or the underwriting, that become the thing that slows down a deal. We've also seen, with a lot more geopolitical uncertainty and politics playing more of a role in business more unexpectedly, I would say, recently, you see more of the deals slowing down as a result of that too, because there may be political uncertainty if they're working with government contractors, or they have government contracts, or they have some funding that in some way is impacted by that, where there's slowdowns on government funding, or there's tariff changes or whatnot. If there's uncertainty, it creates a lot of risk for underwriting. And underwriting, while there may be a lot of lenders that provide business loans, their risk tolerance is not always very high, especially when it comes to geopolitical uncertainty around tariffs or something like that. Especially if a business all of a sudden started doing well, or there's been a sudden dip in the performance, those also tend to slow down deals as well. The other is due diligence for red flags. That's going to come into, I would say, a very small portion of things that slow down deals, but occasionally there's litigation that pops up unexpectedly, or something that's out of everybody's control, and you have to see how that litigation goes or something like that. And then honestly, the biggest thing is responsiveness and response times on both parties. The advisors can only work so quickly as the answers that they receive to do the work that they need to do. Contract negotiation is also a big one. We saw this take over almost a year to do a deal purely because of contract negotiation. And that's, something where I say, expect this to take 6 rounds of negotiation. I think that probably took 15 rounds of negotiation, plus 15 to 20 rounds of negotiation for the purchase agreement. It was absolutely wild. So how can you prepare for this? How can you mitigate delay? First, be moving quickly yourself and clearly communicate what the seller can expect. That's super important, because if you're not communicating, that creates frustration and it breaks down trust, which is ultimately the foundation of getting a deal to closing. You need a foundation of momentum and trust and goodwill from both parties to meaningfully progress towards closing. If you say that you're going to get the purchase agreement to the seller within a week of signing the LOI and you haven't even engaged counsel, that's a way to quickly erode trust and the progress of the deal, especially because most lawyers won't be able to provide a purchase agreement in a week on an LOI they've never seen when they haven't been engaged, for many reasons I'm sure you can understand. In addition to that, just being proactive and clearly communicating expectations, clearly communicating the timeline and what will be needed to get to closing. Also having an agreement on responsiveness. Sometimes we encourage buyers to include that into the LOI, that there's a response time for due diligence, that perhaps even the exclusivity period doesn't begin to wane until the due diligence materials that have been requested have been provided. In addition, you might also provide a timeline in the LOI for expectations on responses back to transaction documents. Generally, you're going to need 2 weeks for the seller and their counsel to review a purchase agreement. And generally, 10 days or less, a week maybe, for ancillary transaction documents, but you want to build all of that in. In addition, if you're trying to move the most quickly, you would run parallel lines of QB and legal. If you're looking to be more financially conservative and you have more time, then you would generally you would engage your attorney immediately after the LOI is signed if you haven't already engaged them, but you might have them. Obviously, they need to start due diligence. As soon as the LOI is signed, we prepare the material deal terms list so that you know what you've negotiated and what we need to strategically decide when we're going to negotiate. We prepare the closing checklist and timeline so that everybody is on the same page of what we need to do when to get to closing. And we also prepare the due diligence request list so that while you're doing quality of earnings review, which generally takes anywhere from 2 to 6 weeks, depending on the complexity and the deliverable, they can be populating the data room with everything that we request, which does take significant time. Most sellers don't have access or easy access to quickly just throw into a Dropbox all of their contracts, all of their all of their corporate governance documents, all of their communications with government regulatory bodies, et cetera. Most of the time they need to pull that from emails or pull that from files and organize it. So first off, engaging legal counsel at the right time so that they can be running that process will make sure that you're not further delaying the process. And then in addition to that, you can always make sure or try to influence and encourage the seller to make sure that they have the right counsel. So even if you're working with other counsel for the acquisition, you can always recommend Dean Street Law to the sellers to work with so that they have M&A counsel. One of the things that does tend to slow things down is if they are working with counsel that is not familiar with mergers and acquisitions. They don't know what's market. They don't know what to expect. They don't know how to negotiate these different documents. Everything's new. Everything takes time. If they don't have that deep experience in mergers and acquisitions, whether they're your buy-side counsel or sell-side counsel, it will delay the deal oftentimes because getting them up to speed, or you might see road bumps or issues that really shouldn't be issues. So sometimes buyers have done that by providing a closing payment to the seller to go towards their legal counsel. If they are able to approve their legal counsel, they wouldn't choose their legal counsel for them, obviously. Or even just having a conversation at the beginning. Hi, have you engaged counsel? We have had a deal actually where it was supposed to close, and 5 days before closing, we'd already negotiated all the deal terms, all the documents and everything. 5 days before it was actually supposed to close, the seller finally engaged counsel, and then it added another month and a half because the counsel went in and renegotiated everything that we'd already negotiated. And obviously that slowed things down considerably and was unexpected from both sides. So that just happened last month, actually. We finally closed a deal that we had planned to close 6 weeks prior because the counsel apparently hadn't been engaged. The seller said that they were working with counsel, but that they would receive emails from everything and work with counsel independently. And we thought that they had already engaged counsel since they were responding to all the transaction documents, but apparently they had not. So first, having a conversation about both parties, when they've engaged counsel, who they've engaged, do they specialize in mergers and acquisitions? And then if you're a buyer and looking to really influence that, because time is money and broken deal costs are money and everything like that, we're seeing more and more buyers offer to provide some sort of financial compensation to the seller solely for being able to approve their legal counsel. So those are how you can avoid it. The other thing is there's just going to be a certain component that you can't fully control. Like I mentioned, consents from third parties. But we have conversations whenever there's consents required, whether it's an asset purchase and there's a consent required for assignment, or it's a stock purchase or membership interest purchase and there is a consent required for change of control or something like that. We talk about what is the risk of this consent. Do you choose to get it before closing? Do you choose to begin working on it before closing? Do you choose to get it after closing? even though you may be in breach of the contract, or you do choose not to get it at all. Sometimes you'll see printer leases that require consent for assignments. And, the printer lease the company that's leasing the printer is probably never going to know that there was a change of control of the business or a change of ownership of the business, as long as their invoice is still getting paid. So in that instance, you may have a situation where a buyer may decide that it's not worth it to get that consent. So those are one thing that is a little bit out of control, but that you can decide how to mitigate and how to address. Government approvals are a whole different thing. And sometimes that's just something where you have to bite the bullet. If you're buying a business that requires government approval for the transfer of the business, that's something that you just know may take 6 months or a year or 2 years or more. It just depends. It is obviously helpful to have a sense of what the general timeline is, but that's something that you just want to make sure you have a sense of, but aren't held to the timeline, and are as flexible as you can be with it, because ultimately if government consent's required, there's not oftentimes much that you can do about it unless there's some wheels that you can grease, relationships that you can make, all that kind of stuff. Obviously, we're not talking bribery. We're just talking about relationships, but sometimes relationships can be something that helps quite a bit. Good communication, clear goals, organizing both parties, the seller and the buyer, will have all beneficial influences on your timeline for closing. Generally, the timeline for closing for a stock purchase and an asset purchase is generally pretty similar. You might be able to do a stock purchase more quickly than an asset purchase, simply because you don't have to document as much in terms of the legal transfer of ownership of the different asset classes. Smaller deals and mid-sized deals generally also take about the same time, but once funding sort of doesn't become an issue, because either, let's say it's a big Fortune 500 company doing a small $100,000 tuck-in, that you could do in a couple weeks and it'd be no big deal. But when you have investor involvement, SBA loans, regulatory issues, those will all increase your timeline. So best thing to do is just manage expectations, plan your own time, work with your own counsel, have the right people in the right place at the right time so that everything's running on all 8 cylinders, and also communicate well to the other party. Making sure that you're moving forward with momentum, even if it's just a call or a conversation while things are going on. Hey, just want to let you know we're working through due diligence. We're getting this back. We're working through these things. We'll get back to you as soon as you can. But keeping that relationship going. Ultimately, it's the relationship that's going to get you to closing. And that's the most important thing to maintain throughout the entire process. I hope that this has been helpful. If it has, please be sure to leave us a 5-star review. Let us know what you'd like to hear next on the podcast. We're thinking of having some more guests, so we'd love to hear who would be helpful for you to hear from, including potentially some prior clients as well. If they're game, we'd love to have them. And if you need anything, please feel free to schedule a consultation call with us at Dean Street Law. We would be happy to walk through our services in greater detail, what you can expect, pricing, etc. As well as be sure to check out my book, Entrepreneurship Through Acquisition, a legal guide to buying a small business. This is a really great way for you to learn more and dive deeper into the process of buying a business. I hope that this has been helpful. Cheers and happy deal making. Thank you so much for joining us on this episode of the Dealmaking with Laura DiFrancesco podcast. I hope you found today's discussion insightful and that it brought you one step closer to mastering the art of mergers and acquisitions. If you enjoyed this episode, please be sure to follow and subscribe to Dealmaking with Laura DiFrancesco on your favorite podcast platform so you never miss an episode. And if you found value in our discussion, please leave a 5-star review. It would mean the world to us, and share this podcast with your network, friends, and colleagues. For more in-depth resources, be sure to visit our website, deanstreetlaw.com, where you can find articles, guides, and more information on our services. Don't forget to follow us on social media for the latest episodes, updates, tips, and exclusive content. You can find us on LinkedIn, Search Funder, at LMDFrancesco on X, and at Dean Street Law on Instagram. Join us on our next episode where we'll explore more deal-making insights. Cheers and happy deal-making.